welcome back. It's still Business Morning. We go global now with Laddie Williams. Laddie?
So another day, and definitely we're seeing movement, when it comes to the global economy, but people are still waiting for those meetings, high-profile meetings, coming up this week. But let's start off.
Sorry, Laddie, before you start off, one of the drivers of oil price this morning is obviously the expectation of the end of the war in Ukraine and sanctions on Russia. But I thought I heard after the meeting, the Alaska meeting, that there will be no sanction on Russian oil anymore while we are in this process of a peace deal. But it seems it's back. The fear of sanction on Russian oil is still there. Perhaps I missed something. Did you get something?
I guess it's still that uncertainty around if, Ukraine is going to give in to, letting out, some of its...
Crimea, I think.
That's Crimea. But at the end of the day, those sanctions, if they remain, at this point, that means less oil that's coming out from Russia.
So it doesn't.
But if the sanctions, are lifted and
then
maybe stay lifted, then there's more oil.
So I guess we haven't heard the status or the stance of President Trump on the sanction on Russian oil while the talk is going on. I know the next thing we're expecting is the tripartite talk, Russia, Ukraine, and the U.S. But while this process is on, will there be sanctions on Russian oil? I think that's the uncertainty.
That's where there's serious uncertainty. And we know how investors react. Once there's uncertainty, they try to just stay on the sideline. At this point, and that's why we're seeing exactly. That's why we're seeing depressed prices there. But let's start off in Asia now. See the People's Bank of China. They kept their benchmark loan prime rate unchanged as expected. Today, with Beijing seeing resulting more fiscal measures to boost growth instead of further loosening monetary policy. The People's Bank of China kept its one-year loan prime rate at 3.0% as expected, while its 5-year LPR, which is used to determine mortgage rates, that remain unchanged at 3.5%. Both rates were at historical lows after a slew of cuts by Beijing over the past 3 years. So we're seeing those rates kept low there. Then we see in Japan, they posted an unexpected trade deficit in July as exports fell for a third straight month. That's for Japan, weighed down by softer global demand and the impact of shifting U.S. trade policies. Government data released today showed a deficit of 117.5 billion yen. That's about $800 million. Missing forecast for 196.2 billion yen surplus and reversing from 152.1 billion yen surplus in June. Exports dropped to 2.6% year-on-year, a steeper fall than expected. That's a 2.1% decline, with autos and steel particularly hit by U.S. tariffs. So we're seeing the impact there of the tariffs. Then we head on to the U.K. now. We see UK inflation ticked higher in July, with consumer prices rising 3.8% year-on-year, up from 3.6% in June, and just above expectations of 3.7%, according to official data. The uptick was fueled mainly by energy costs as fuel price inflation eased its decline from 9.0% in June to 6.7% in July, lifting the headline rate by 0.1 percentage points. Services inflation also pushed the figure higher, climbing to 5.0% from 4.7% and surpassing the Bank of England's 4.9% forecast. The increase reflected base effects in communications and hospitality, alongside a sharp 30.2% monthly surge in airfares tied to the school holiday period. And that takes me to Canada now. We got Canada's headline inflation. Consumer price index eased to 1.7% year-on-year in July, down from June's 1.9%, excluding gasoline. Core inflation held firmer at 2.5%, steady with June, while underlying Bank of Ghana measures remain elevated. The CPI median at 3.1% and the CPI trim, that was at 3.0%. Joining me now to discuss, we have Julian Karagwasian. He's a visiting lecturer in economics at McGill University in Montreal and former special advisor in the Ministry of Finance in Canada. Great to have you on the show. Good morning.
Good morning, Laddie. Nice to be here.
Fantastic. So what were the key, the main factors contributing to the decrease in Canada's headline CPI inflation in July, and what specific components saw, the declines there?
The specific component that saw a decline that drove the headline inflation rate down to 1.7 was energy costs. But there's a couple of other dynamics that are a little worrisome, but that was the main factor driving the headline inflation rate down.
All right, so, definitely, I guess that's good news, at this point. But are there any underlying risks that you've seen in the data that suggests that, the Canadians might not be out of the woods yet?
Well, I think you see this trend towards more and more housing, unaffordability, shelter costs were up over 3%, and that was driven by I think over 5% increase in rent. And food prices continue, or food inflation continues to be positive. Food inflation's up over 3%. And so these are underlying trends that are masked by the decline in the headline rate, but those are some underlying worrisome trends that I would be looking out for very closely.
And definitely economists and experts there would have more forecasts at this point. Seeing the inflation numbers coming out quite good at this point. So in your view, what are you seeing in this second half of 2025 for Canada's economy?
I do think that the headline inflation rate will remain subdued. I think part of the reason, so we've seen a pretty strong labor market this year, but I think part of the reason in the second half of this year that inflation will remain subdued is the slowing of the economy. Really weak investment growth as a result of the trade policy uncertainty. So those are really big factors that will keep inflation contained and may give the Bank of Canada some room to lower interest rates given the softening economy.
And we've seen, the talks in Alaska with, President Putin, President Trump. We've also seen the one with President Zelensky and, with European leaders. So the meetings are going on. But how are you guys in Canada seeing, what's playing out, this week, with all of these high-level meetings?
Well, for the way we're seeing it up north here in Canada, I think there's going to have to be, for an end to this war and to bring Russia and Ukraine and all the parties at the table together, there is going to have to be, every side's going to have to give up something to end the war. And so we're waiting. We're a part of that. Canada's obviously a part of NATO, and we're aligned with the allies. The way I see this playing out is that some concessions are going to have to be given, some painful ones on all sides, in order to end the conflict and add some more certainty to the global economic outlook.
Right, and you did mention, painful, concessions on every side. But, when you look at it, we're seeing Ukraine, they're having to, give up some of their, their country, at this point. And, definitely Russia will be on the receiving end, of that. Do you think, Russia's giving up much, or they have much to give up, in the war?
I think we could probably end this conflict without having Ukraine give up more territory than Crimea, which was, before the 1950s with Russia, and was put in Ukraine for administrative reasons. No one ever thought the USSR would collapse, but I don't think Ukraine has to give up territory. I think both countries need security guarantees. One needs security guarantees from the West, that's Ukraine, and Russia's looking for guarantees to have no more NATO expansion. And so perhaps the end of the war can turn on this kind of negotiation rather than Ukraine having to give up territory, which it shouldn't have to do. And I think Russia's looking for an end to NATO expansion to its borders.
All right, definitely everything is going on right now. Definitely, we're trying to find, expectations of what happens with the global economy when it comes to inflation, currency. But still looking at, Canada's inflation now, we see, analysts suggesting that the Bank of Canada may have, room to deliver more easing, when it comes to interest rates. What does this mean, in the context of monetary policy, and why might the central bank, consider lowering interest rates further, even though we still have those, underlying risks there?
I think that probably the main driver or motivation for the Bank of Canada to be able to, one of the drivers to be able to lower rates is the fact that the economy, the Canadian economy, is now feeling the effects of extreme trade policy uncertainty. And this is affecting investment, it's affecting the overall economic outlook. And so I think ultimately this is what will sway the Bank of Canada to lower interest rates in the second half of the year, in the fall, unless there's some offsetting changes on the horizon. But as we're looking right now with current economic dynamics, I believe they will have the room and the motivation to ease off more on monetary policy.
All right, let's try to imagine now, the Bank of Canada, cutting rates at some point this year or not cutting. What does it mean for the Canadian dollar?
Well, that's one of the key questions, Laddie. I think if the Americans return to an easing cycle, that will give us the ability to return to an easing cycle without having Canadian dollar depreciation. If the Federal Reserve holds fast and does not reduce their interest rate, their Fed funds rate, and we reduce our rate, that will lead, that will push Canada in a softening direction, the Canadian dollar.
All right, and definitely, I guess that's good for the Canadian people. We're seeing the inflation numbers still trending downward, and possibility of the Canadian dollar there softening. I guess that's good news.
That is good. That will be good for exports. At the same time, the across the board depreciation effects of the Canadian dollar will make imports more expensive and could provide some kind of positive impulse to inflation.
All right, yeah, I guess a lot to look out for there in the Canadian economy in this second half of 2025. But thank you so much for breaking it down, for us. The latest July inflation right there, easing numbers. That was Mr. Julian Karagweshian there, right there in Canada, helping us break it down. Thank you so much for coming on the show today.
Thank you, Laddie. Thank you for having me. Pleasure.
All right. So yeah, we have markets that don't sleep at this point. And that's talking about Bitcoin there hitting a 2-week low near $113,000. Remember, it touched $124,000. Briefly. That didn't last very long, but we've seen downtrend since hitting that milestone, and now it's trading $113,000. And there's still analysts who believe there's still weakness coming. There's still uncertainty, and hitting a 2-week low. Some investors might find that as a buying opportunity, while some might be afraid at this point, thinking that there might still be some lows coming for Bitcoin. So all eyes on the Federal Reserve's Jackson Hole Symposium, and also geopolitical risk. Investors keeping their eyes on what's playing out with Russia and Ukraine, with talks ahead. But we see the currency there, risk assets. Almost seems like risk-off sentiment might be coming into play at this point, Ini.
Yeah, well, it looks that way, especially for the cryptocurrency investors.
And it doesn't get riskier than this, Bitcoin.
Really? We used to have it at 60,000, so...
Right.
I just wanted to remind you that.
Exactly. Wow. That seems so long ago.
It seems so long ago.
But it happened.
It happened. I think it was this year.
happened too.
Yes. No, I think 65 we had this year.
Yeah, about this year, before President Trump, got into office.
Yes. So. I mean, so it's not so far away, but let's keep our minds open.
Right.
And pockets. Thank you, Laddie. All right, just before we go, I'll tell you that the Nigerian stock market yesterday closed almost 1.5% down in the red, and we're down now to 142,000 level. Also, lost all of the trillions of naira to close at 90.22 trillion naira is what the market cap closed at yesterday. Activity mostly green, but I mean, you know, from the day before. Top gainers, NML Wear, Dark Communication, the unusual ones, top the gray. But when you see the top losers, that's what tells you what's going on in the market at this time. Insurance, we know, has been at the top there. So a lot of profit taking is happening right there. But yesterday's one was led by Dangote Cement, but also the insurance. They moved the market to the green side. We'll see if there'll be a little bit of recovery. We've had negative trade since 3 days last week and second one yesterday this week. So 5 consecutive. We don't want to wipe off all the profits we have made, but that's where we are. Perhaps some investors will be attracted to the market at the lower prices by intraday. Laddie Williams will be here to give you that story. 1:30 is the time for Business Incorporated, and Laddie will be here to give you the gist of that. I'm Ini John Mekwa, and that is all I have for you on Business Morning today. I'll see you tomorrow, God's grace.